Who's going to join us. He says this recent pullback will be short-lived. He's actually expecting a year-end rally with less than a month left to go in this year. Let's bring in our headliner, Keith Banks. He's vice chairman of Bank of America and the head of the Investment Solutions Group. Keith, great to have you here today on a day like this.
Thank you, Frank. Good to be with you and the investment committee.
So Omicron's obviously spooking investors to some degree. All the indices, they're looking like they're going to finish this week negative unless we see some dramatic turnaround. But you say any pullback that we're experiencing right now is going to be short-lived. Not a lot of time left in 2021. Dr. Fauci saying we won't have a lot of answers about Omicron for like another 2 weeks. So where do you see this pullback ending?
Well, look, it's hard to say whether we in fact will see, a rally at the end of the year. We think there's a good possibility we will. But what we step back and look at is, number one, the assumption we're making is, Omicron is not going to derail the economy, result in shutdowns. That's kind of a necessary condition, obviously, for the markets to continue to trend upwards. But if you put that aside, and obviously it's a very important factor that we're watching closely, we think growth right now in the fourth quarter is going to be extremely strong. Real growth probably 6% or higher. In the first 2 quarters of next year, real growth 4% or higher. That means nominal growth is double digit. And if you just allow the translation that we've seen so far continue, meaning nominal growth at that level is going to drive very strong revenue growth. And as companies continue to focus on expenses, and those companies that can pass on higher labor materials costs, operating leverage will be extremely strong. And we think, that dynamic, which is what drove stocks primarily in 2021, will be the driver next year in 2022. Now, I will tell you, we're not looking for the outsized gains we saw the last 2 years. We would give you a range next year of between, call it 6 to 12%. So roughly tracking what we're looking for in terms of earnings growth plus the dividend yield on top of that.